Yeah, so I think if you strip out the big reserve releases, underlying or pre-provision profit was actually a 10% beat. So still some pretty good numbers. And driving that was really the strength in the trading side, particularly equities trading was strong. And the investment banking, their equity underwriting was up 400% year on year. So they're pretty big in SPACs, and that has been a boom market over the past quarter. So that was driving a lot of the strength, and expenses were well controlled too. But on the loan growth, the issue there really is that the consumers are doing better than expected. So what they're doing is they're paying down their credit cards, and Citigroup's very large in credit cards. So that's really hurting them in particular on the loan growth. Obviously, they're expecting that to rebound in the second half of the year, but in the near term, the consumer strength and the stimulus packages, I think consumers being pretty wise and paying down their credit cards. So that's a bit of a headwind for the banks.
John, how closely do you think these banks' fortunes are tied to the performance of capital markets? And this has been a consistent theme over the last couple of quarters, Q4, Q1 now, we're seeing it. But if for whatever reason capital markets activity starts to subside, either because the market turns or because of further regulation in the space, how much of an issue do you think that will be for some of these investment banks?
Well, I think expectations have been set pretty low on capital markets. Most of the management teams are really saying, well, we think capital markets were exceptionally strong in 2020 because of all the volatility around the pandemic. So you should really be looking at 2019 levels. So most people have been quite cautious in their outlook. However, Citigroup management yesterday saying they're now expecting trading to be somewhere between 2019 and 2020 during 2021. So actually slightly increasing their revenue guidance on the back of stronger trading, not just because of what happened in Q1 this year, but also what they're seeing for Q2. So I think there is a potential for that to come down, and that's fully expected. But actually, it's proving to be a little bit stronger than people expected. So that's helping them.
The other big development in this quarter was the big sell-off we continue to see in yields and the yield curve steepening. I just wonder to what extent that's going to start showing up in these banks' numbers, particularly as it pertains to the NIMS margins. And there, of course, you've got two competing factors. You've got the steepness of the yield curve, but on the other hand, you've got deposits and a lot of competition going on in that space. So how do you square the two up?
Yeah, so you're right. There's huge growth in deposits, which are keeping the cost of funding low. It's sort of less of a concern for the banks, really. The big issue, you've got this yield curve steepening, which should be theoretically very positive for the banks. There's just a lack of loan growth. So until that loan growth starts to pick up, they can't really take the benefit from the steepening yield curve. And so what you have to see is, particularly on the consumer side, you have to see a recovery in loan balances. And management teams are really expecting that to happen in the second half of the year. Obviously, you've got a very strong economy coming through. Consumer or retail sales numbers we saw yesterday, almost double what people were expecting in March. Retail sales up 9.8%. So that's very encouraging, but you need to see that translate into consumer spending, which is starting to come through. But the stimulus packages mean the consumers have got more money, more deposits to actually go out and spend without borrowing from the banks. So they need to work through those stimulus packages first and then start borrowing a little bit more on their credit cards and other loans. So we think that will happen. It's just probably more second half of the year story.